What's up, everybody? It is Monday, April 20th. And there's an old saying, if you live long enough, you get to see everything. And boy, I saw everything today, as I'm sure many of you did, with negative oil prices. And not just negative by a couple of cents, although that in itself would have been extraordinary. But how about negative to the tune of $40 a barrel for crude? Negative $40 a barrel for crude. And it was a truly bizarre day. I mean, the price just kept falling and falling and falling. This is the May crude futures contract traded on NYMEX, closed down. I believe it closed down negative 37 or negative 38, but it did touch negative 40. And there are some physical spot crude prices in the U.S. now trading at minus 50, minus 56. Truly bizarre, truly unbelievable. Let me try to make some sense out of how and why this occurred. And I'm not professing to know the absolute reason. I mean, a lot of this, to me, having been involved in markets for over 40 years, a lot of this to me looks like just sheer desperation and panic. It is one of these moves that we see from time to time in markets where all rationality is thrown out the window and it just becomes sheer, unadulterated mass panic. But let me try to break it down a little bit. There was, I think, a confluence of factors causing this. First of all, the May contract on NYMEX is set to stop trading. It's set to expire tomorrow. That's Tuesday, April 21st. The contract, there was a large embedded long position in that contract held by these oil ETFs like USO. USO is the largest oil ETF. I think it has something like 3.5 billion. And interestingly enough, it has received a large amount of new inflows of capital, of money over the past few weeks. Like this is a retail instrument that retail investors typically use to, if they want to go long or buy oil. They've been buying as the market's been coming down. So normally what happens, because this ETF invests in futures contracts, and they typically hold the front month futures contract and then maybe the second month, and then but most of that most of that position is concentrated in the first month, and then 2 weeks prior to the expiration they roll out of that. In other words, they sell the front month and then they buy the next month, which will eventually become the front month. So they're selling the May, they're buying the June. The selling of the May, and they had an enormous long position in this contract. I think they held something like almost 30% of the open interest of the front month. And they were rolling out of it, which put downward pressure on the front month contract. Now, I don't know if they were still doing that, because I think they start to do this 2 weeks prior to expiration, from my understanding, but I guess this touched off a cascade. There were other ETFs also that employ the same strategy, and they're selling. They're selling the front month, they're rolling into the second month. And by the way, USO specifically announced a change in its in the way it invests. It said this last Thursday that now it was going to invest mostly in the second month and the third month. So they're no longer doing this first month. Anyway, that's a whole separate discussion. So these ETFs, which held very large, as a matter of fact, there was a 440,000 open long position held by these ETFs, and that doesn't include, what speculators held, what commercial entities held, dealers, in other words, etc. So this selling in the front month, I think, touched off a cascade of selling the word got out, maybe some firms or speculators front ran that selling. They knew it was going to happen. I mean, I remember this from my floor days. Like if we knew some big trader or some firm had a big position that they needed to unload, we jump in front of that and we knock the price down, or we bid the price up just to, you know, make them have to pay more or sell at a lower price to give us an advantage. So that probably was something going on as well. But there's another factor here, and that has to do, I think, more fundamentally with the situation, and that is, from what we are hearing, there is little or no storage capacity for oil. And as you know, if you've been following along with the weekly inventory reports, oil supply is just gushing out all over the place throughout the world. I mean, we have enormous amounts of supply. Demand is way down because the economy is shut down because of the coronavirus. And so this supply has nowhere to go. And the problem is producers, particularly here in the United States, these shale guys, they don't want to stop producing. Their cutbacks so far have been very modest compared to the amount which the price has come down. I mean, a lot of these guys are underwater, and I guess they feel it's better to pump and make a little bit of money than to shut down completely and not be able to pay their bills, not be able to pay their loans, not be able to pay their workers. So they're still pumping to try to make some money. Nobody's taking the oil because demand is so low. So they're literally paying what is a negative price for oil? It literally says that the producers are paying their customers to take the oil off their hands in the hopes that soon the price will rebound. So they're not shutting down production to the extent they probably should or have to. They're holding on, trying to earn some money, as little as that might be, and now they are paying their customers to take that crude off their hand. The problem is the customers, unless they're using it immediately, there's no place to store it. So it's inevitable that production is going to have to drop dramatically. This negative crude price is just forestalling the inevitable, which is a dramatic drop in production. So what does that mean? It means the negative price is going to last for a very short period of time. It is dramatic. It is almost bizarre to look at, because you say, how can crude, something so vital, have basically no value? That the producers are paying people to take it off their hands. It's a bizarre, weird, crazy situation. It's not going to last that long, but it's very disruptive, both economically and also psychologically, right? I mean, you saw what happened in the stock market today, gave up almost 600 points. By the way, on Friday it was up 700 points, so we're still net, you know, up by 100 points basis where we were on Friday. So that's where it's at. How do you play this? Number one, stay away from these ETFs, particularly if you're talking about a commodity that has a positive curve. What do I mean by that? Positive curve, often called a contango in the commodity world. That means where futures prices trade at a premium to nearby prices. Because the problem with that, with these ETFs, is that every time they roll from the expiring front month contract to the next nearby, they're paying a premium. Every month they're paying a premium, and that reduces your return. In some cases, it can make your return negative, right? The premium right now in the May-June is something like negative 300% per month, or at least in this month. So, I mean, crude could have an enormous price increase. If you are in that ETF, you're not going to make any money because you're paying an enormous roll cost. We'll see what the By the way, the June contract and the July contract, they weren't down that much. They're down about 15%, 10% respectively. The May contract was down 186%. All right. Brent was down about 10%. All this may seem hard to digest and hard to understand. Just follow along. I mean, it's a crazy, bizarro situation. It's not going to last that long. But basically, it says the market is saying we're going to have a major decline in production. And when we have a major decline in production, and now you got to think the economy's coming back. We're starting to open up parts of the economy. Next month in May, more of these restrictions are going to be relaxed. In June as well. So the economy is going to start to slowly come back on stream. We're going to have a massive reduction in crude output. You know, prices will rebound. But right now, bizarro world, negative oil prices. It's a historic development. Look at it. There'll be some money to be made here. We got to watch it though. I sent out the new issue of MMT Trader today. Go to my website, pitbulleconomics.com. Sign up for a 30-day free trial. The link is in the description below. All right, everybody. See you tomorrow. Bye-bye.